First, welcome everyone to today's seminar. We're going to be talking and learning how to build your investment confidence. My name is Fernando Garcia, and I'm actually one of the advisors here at Excel Wealth Management. So today we're going to go over some simple steps to help you be more comfortable with how your investments are set up today. Now, as always, this presentation is for educational purposes only. And for those that just joined a little bit ago and did not hear my initial spiel, if you do have any questions, make sure that you use the Q&A box and not the chat feature, okay? So Q&A box. And then at the end of the presentation, we will get to those questions, okay? All right. So, investing doesn't have to be complicated. You do not need to be an expert or have a lot of money, but we do suggest that you guys have a plan and be consistent throughout that journey. So, why is investing important? Well, this is one of the things that we like to tell the people we work with, whether it's a 401k, IRAs, anything like that, is people don't realize that Social Security will only cover about 40% of your income in retirement. So that means that the other 60% has to come from somewhere else, and that somewhere else has to be from you guys. So you're probably asking, well, why is that? Well, one, we're living a lot longer, right? And your money needs to last too. And that could be anywhere from 20 to 30 years past retirement. Just the other day, I was in a meeting and the individual's father had just turned 105 years old. So again, we're living a lot longer. Back in the day, you're getting to 60s, and that was a big achievement. Then it was 80s, and now everybody's getting to 100. So again, that money needs to last. The other thing too is things are getting a lot more expensive, right? One example that I like to give is, the McDonald's cheeseburger. Back in the day, you could get a McDonald's cheeseburger for $1. Now that same cheeseburger is going to be on the, I believe it's like the 3 and under, right? So, inflation. The last one is going to be financial independence. That is what's going to give you freedom to do whatever you want, whenever you want, whether it's taking a trip or if you're, closer to retire or in retirement, it's going to be, spoiling your grandkids if you have any. Otherwise, find me and take me on a trip, whatever you want to do. But you make sure you use that money. All right. So when it comes to saving versus investing, the main thing is knowing what your goals are. Are you setting money aside for short-term goals or long-term goals? Once you have that clear goal set, then you will have options. So let's start with the savings. Savings is a great avenue for those short-term needs. It is easily accessible with lower risk and low to no returns. One thing I was actually researching, and did you know that the average traditional savings account, the interest rate is 0.01%. So you guys are pretty much earning cents on your money that is in the bank account, right? Now, some examples of short-term needs or short-term, goals is going to be that emergency fund. So having enough money in case something happens to your car, something happens to the house, right? Having a home repair or unexpected medical bill. Maybe you're trying to go on a vacation later in the year or sometime next year, right? Saving for those things are going to be important. Now, investing, on the other hand, is one of the main ways people invest these days is going to be for the long term. It can have higher risk, but also the potential for higher returns. An example of a long-term goal can be, saving for your kids' college tuition, so a college savings. Or one of the more popular ones these days is going to be saving for retirement, right? So now that we have those down, let's look at an example at the difference between putting money in your savings account versus a long-term investing here on the next slide. So just like anything that we do, this example is for illustrative purposes only. So remember, when you put money on your savings account, it will have very little to no growth. Let's say you put $70 a month on a savings account for 5 years. At the end of those 5 years, you're going to have $4,200 sitting there waiting for you to use, right? And you're going to be earning a few pennies every year on that. Now let's take a look at the long-term opportunity. You take those $4,200 with no additional money going into that account. You invest it for 30 years in a moderate portfolio that gives you an 8% average annual return. We will have an estimated retirement savings of just over $42,000. So from the 4,200 to the $42,000. Now you tell me which one has more value, right? Do you just want to keep it in the savings account earning pennies, or do you want to put it and invest it for the long term? All right, so now you're probably asking yourself, okay, great. Where do I start? We start by understanding the types of investments. So when people think of investments, right, they think of individual stocks. There's more to that. We have stocks, bonds, mutual funds, and a lot more, but we're going to focus on those three. Now, one thing to keep in mind is that investing obviously involves risk, and your investment mix should match your goal, time horizon, and your comfort with risk. Okay, so let's take a deeper look at each of these three. So stocks, for those that are new to investing, right, or don't have much knowledge on investing, when they think of stocks, they think of that individual, right? This is where you purchase a small piece of an individual company. It has growth potential, but it also has higher risk involved with that one company. So you will be getting the highs when the company is doing really well. But guess what? Because all your money is going to be tied up into that one company, you're going to feel the lows a lot more too. So again, you're going to feel those highs and those lows a lot more when you're just invested into one individual stock. So stocks are going to be suitable for long-term investors and those that have a higher risk tolerance as well. Now, bonds, on the other hand, are going to be a little bit different. Bonds are more like a loan, where you are lending money to a company. It is known to have the potential for regular interest payments with less risk than stocks. One thing to keep in mind is credit risk. Just like when you guys go and get a loan and you have a higher credit score, you're going to get a lower interest rate, right? That means that you're viewed as less risky than someone with a lower credit score and their ability to pay back that loan. So typically, the lower the credit score, the credit risk for that company, the lower the return you will get on that investment. Bonds are going to be suitable for those people looking for stability or protecting what you have already built rather than growth like the stocks are made for, right? Okay, so we just looked at stocks and bonds, so individual investments and how the risk stays with one company, right? So we have all heard the saying, "Don't put all your eggs in one basket," right? This is where mutual funds step in. These are a collection of stocks, bonds, and other assets. It is diversified across many companies and industries, and it is smoothing out that risk. It is also simplified for you guys. So mutual funds are professionally managed, and those options are suited for all types of investors that want the heavy lifting done for them. So again, if you just want, boom, I just want to let somebody else deal with it, mutual funds are a great thing. Now, if you're looking for growth or stability, these funds can be diversified according to that risk. Now let's take it one step farther. So now we looked at the individual stuff and mutual funds. Let's go into the retirement space. This is where a lot of people start, whether it's a 401k that is offered through your employer, or let's say they don't offer one, you do have the opportunity and the ability to open an IRA as well. So again, you do have the 401k offered by an employer, or you can open an individual account. And we'll take a look at those here in a bit. So why the 401k and the IRA? So if your employer offers the 401k, guys, make sure you guys get enrolled. 401k plans are automated and they're simple. So what does that mean? Your contribution will come out automatically from your paycheck. Just set the deferral percentage, forget about it. Every time you get paid, that money is going to go in. Now, the 401k, it is limited on how and when you can access your money, and you can only use funds that are available through the plan, right? You cannot go outside of that. You do have higher limits. So if you are under the age of 50, you can contribute up to $24,500 into your 401k. If you are between the ages of 50 and 59, you can contribute an additional $8,000 called the catch-up contribution. Now, if you're between the ages of 60 and 63, that catch-up contribution goes from 8,000 to 11,250. Now, let's say you continued to work past that 63, then the catch-up contribution goes back down to $8,000. So now let's look at the IRA option. Like I said before, this one offers more control, more access to your money, and it also gives you a wider investment selection that you would get through the 401k. Now, the IRA is I wouldn't say downside, but the difference between the 401k and the IRA is that the IRA has a lower limit that you can contribute on a yearly basis. And that limit is, if you're under the age of 50, is going to be $7,500. If you are above 50, it's going to be $8,600. Now, people are like, well, should I be doing both? It's okay to have a balance between the two. And we encourage that if you are in a position to be saving more, to do it, right? You have the option. Now, you only get one limit per year, so might as well take advantage of that. If you guys have any questions on how the IRAs work or how to open one, make sure you let us know and we can help you and guide you through that process. All right, so now the investors, right? So what kind of investor are you? Do you like to be involved or do you want it done for you? Most people like to be guided, and there is absolutely nothing wrong with that. For those guided investors, there are funds based on your retirement year that is estimating when you're going to retire, and the funds automatically adjust the risk and mix as you age. When you're younger, you can take more risk. When you're older, the last thing you want is for your money to be put at a higher risk. So again, these funds will do the work for you as you age. If you're a hands-on investor, that means that you want to pick your own funds, that you want to set your own risk. Just remember that when you set your own funds, it will stay at that risk until you change it. Okay. So again, one is doing it for you. The other one, you have to do it yourself. All right. So as a hands-on investor, you will have options from low risk, like short-term fixed income funds, to high risk with international and global funds. For those that are guided investors, let me go into here. There you go. For those that are guided investors, most 401ks plans have you go into a target date fund as a default. That means that if you do nothing and make no choices, you're automatically placed in a target date fund. Remember, target date funds are estimating your retirement year. So you're going to take your birth year, you're going to add 65, and whatever date is closer to your target date fund, I mean to whatever it is, that's what you're going to put, right? So it could be target date fund 2045. It's estimating that you're going to retire in the year 2045. Now, target date funds are a great option whether you're just getting started or you're getting closer to retirement because they're a well diversified uh, fund and they're aligned to your age. Now, this next one here, investing 101. So investing 101 says that we should be buying low and selling high, right? Well, the reality is that we cannot predict the future. So the key is just to get started and stay consistent. We also have something called the dollar cost averaging that is investing the same amount of money on a regular basis, no matter what the market is doing. And we will actually look at an example of this dollar cost averaging here in the next slide. You also have to make sure that you're not putting all your eggs or your money into one basket. So diversifying according to your wanted risk is going to be very important. Now, the last one and I will say the most important is that we know life happens. Just know that you can adjust along the way, whether you're pausing your contributions, you're lowering it, you're increasing it, or even changing the risk. That can all be done at any time. Okay, so don't feel like you're stuck. All right, let's take a deeper look at that dollar cost averaging and how it works. So like I said, you're going to invest a fixed amount on a regular basis, whether it is, once a week, once a month, you name it. When prices are low, you're going to be buying more shares. When prices are high, you're going to buy fewer shares. Now, over time, this strategy can help you lower your average cost per share. One thing you should know is that 401ks are set up to do this, right? With your money going in every time you get paid, no matter what the market is doing, right? If you're getting paid weekly, that money is going to go in weekly. If you're getting paid bi-weekly, boom, or twice a month, or whatever that is, that money is going to go in at different prices. Okay. Now, mistakes can be minimized with a little bit of planning, but here are some common mistakes. For those of you that are in your 40s and 50s, right? If you could go back in time, what would you tell your younger self? Probably quite a lot sooner, right? So a lot of people want to wait and try to get in at the right time, and then they get paralyzed trying to make a decision because they don't have a plan. And then 10, 20 years have gone by and they never got started because they never found the right time, right? So it's just getting started. Another big one is trying to chase returns. So forgetting to diversify, putting all your money into a singular stock or bond and having higher risk with your money. Now, the last one, the emotional selling. That is people letting social media or the news drive their decisions. Make sure that you guys are talking to your personal or your 401k advisor before you guys make any decisions. Okay. Now, this one here is a big one. And I need you guys to really pay attention to this one. People don't understand that time in the market is more valuable than trying to time the market. And let's look at a quick example here. And for those of you that, have done a 401k presentation with me, you probably know this one. But for those that are not, let's take a look at Ashley and Michael. So we have Ashley who started saving at 21, right? Michael started a little bit later at 35 years of age. Ashley only contributed for 14 years, while Michael contributed for double than Ashley did. Now they both contributed the same amount every week, and they both had the same return throughout that year. And then after those 14 years that Ashley contributed, she only contributed a total of $42,000. While Michael, because he started later and contributed for more, had double that what Ashley contributed as a total. But after they both retired at 67, because Ashley started a lot sooner, Ashley had double the money, or just a little bit less than double the money than Michael did. So again, it doesn't matter. It's not always about how much money you're putting, but how soon you're starting and you're letting that compound growth go with you, right? So again, it's not about how much money you're putting, but how soon you're starting. So the goal for today is feeling comfortable and at ease that you pick the right investments, right? So here are a few simple steps to help you have peace of mind. So first, let's try to understand what your goals are. Have a plan. So are you setting money aside for short term or long term? Understand how much risk you are willing to take. Make sure the portfolio is properly diversified according to that desired risk, and stay consistent putting that money away, right? Now, I will say it again. Do not feel like you're stuck. We know life happens and you can adjust as you go. Now, for those of you that want to understand your risk, you have options. Some 401k vendors have what they call the risk assessment questionnaire out there that will help you identify where you are in that scale. Are you going to be more conservative? Are you going to be right in the middle? Are you going to be that moderate investor, or are you going to be that aggressive, right? So you're gonna find out where you are in that scale. So make sure that you guys are checking or contacting your 401k advisor so they can help you with that too. Or reach out to us and we can try to send you either a link or go over those options online. Okay. Now, before I let you guys go, a few things. Make sure that you guys start today if you're not already. If your employer offers you a 401k and they're giving you a match, make sure that you guys are taking it. So again, if the match is 3%, make sure that you are at least putting down 3%. That is like getting a raise, right? You won't see it now, but you will see it when you retire. Make sure that you guys are having a clear goal and understand how much risk you're willing to take, but also make sure that you review and adjust as you go. Know that you have many resources, and we are one of those. So if you want to connect with one of our financial advisors and start your financial planning process, I will share our contact information on the next slide. We can meet you guys in person or virtually. So here I will leave this slide up for a little bit so you guys can either take a picture, write it down, or scan the QR code. And then I will open it up for some questions. Do we have any questions, Julie?
No. If you guys have any questions, please put them in the Q&A and we can answer those. But right now we do not have any in the queue.
No worries. We'll give it a minute for them to either scan or take a picture of this. But yeah, like I said, guys, if you guys have any questions, do not hesitate to reach out. Doesn't matter how big or small the question is. We're here to help you. Anything came through, Julie?
No.
No? All righty. Well, you guys enjoy the rest of your
Hold on.
day. Oh,
Yes,
here we go.
we do
What
have
we
a couple now.
Okay.
All right. I feel like I get overwhelmed because there is so much to know, but I want to start. I just don't.
Yeah, no, that is actually, you're not the only one. Make sure that you send us an email and we can talk about, because everybody's going to be different, right? We have everybody who's going to be in a different financial situation. So make sure that you reach out to us and we can talk more about what you got going on.
Okay. And there will be a survey at the end. So if you answer that, we can definitely reach out to you with that as well. But we do have another one. Any concerns about as people get closer to retirement age and they become too concerned with risk, as in they are too conservative with investments and their return doesn't keep up with inflation?
Okay, that's a great question. I want to see if Mitch is around to help me answer that question.
I am. Um, uh, that that is probably one of the biggest questions I think many individuals, especially approaching retirement, have. It really comes down to having a balance and understanding of what your cash needs are in retirement. Many times when we do meet with individuals, and as Fernando said throughout this presentation, this is where we can definitely sit down with you, have a complimentary review, and go through that planning process. Because we do want to make sure that the income that you are getting in retirement, a portion of that income is coming from or has what we call a capital preservation to it. There's not going to be much risk with it. There may be a bucket of money where we might maybe want to have some of that balance, where we do want to have some market risk, but we don't want to have those impacts if we do see those downturns potential in the markets. But then we do want to make sure that there is that bucket of money along the way that is keeping up with inflation. And so it's really dividing how the different money that we have identified in retirement for you is working in those tranches or in those buckets appropriately in the current year, over the next 2 to 3 years, or 5 years or more. So, great question. This is where, if you are within that 5 years of retirement and you do want to sit down and get some better clarity of how that money can work best for you, definitely reach out. More than happy to go through and do that complimentary review.
All right. Okay, another one. These are great questions, so please keep them coming in. But can you describe the difference between an IRA and a Roth IRA?
Yeah. So the IRA, the 401k, so the Roth IRA and the Roth IRA and IRA, right? So the traditional IRA is going to be done with pre-tax money. So that's going to be done before. So your contributions are going to be going in before taxes are taken out. So that means that you won't pay taxes now, but you will pay them in the future. And the Roth IRA is going to be the complete opposite. It's going to go in with already taxed money, and then you can withdraw that money tax-free if you meet certain conditions when you take that money out. So again, one, you're paying taxes now, which is the Roth, and the traditional IRA is going to be, you're going to be paying taxes at retirement.
All right, that was the last question.
Okay, perfect. Well, you guys enjoy the rest of your day, and yeah, if anybody needs anything, don't hesitate to reach out.